Right, I'm Alvin from Big Fat Purse. Alright, so today's topic is on, of course, our dear Warren Buffett, who is the most successful investor. And a lot of books and a lot of videos are always talking about Warren Buffett investment strategy and how one can emulate his ways to invest and pick stocks based on his criteria. But my point of view is that as a retail investor, it is very difficult for you to actually succeed by following Warren Buffett because he has a lot of advantages that retail guy, average Joe, doesn't have. So the purpose of this presentation is to explain to you what are these advantages that Warren Buffett actually enjoys. All right, let's begin. So Warren Buffett now ranked as the top 3 richest men in the world with $3.8 billion. All right, and of course, among the people in the Forbes list, he is definitely one that stands out because he himself has always been seen as an investor rather than a businessman. But actually, if you ask me, he's more like a businessman than an investor. We'll find out more as we go along this presentation. This is his track record. His company is Berkshire Hathaway, and for the same period, a 50 years return, 1965 to 2015, all right, Berkshire Hathaway has compounded at an annual rate of 20.8% as compared to S&P 500, which is around 9.7%. So, of course, if you have invested with Berkshire Hathaway 50 years ago, or when Singapore achieved independence, you have an overall gain of 1.5 million percentage gain. Okay, so how does it translate to dollar cents? If let's say you have invested $1,000 in Berkshire Hathaway in 1965, you would have $12.6 million in 2015. It's quite a startling figure. This is the magic of compounding returns and how you can achieve a good long-term retirement nest egg when you start young, right? 50 years. And let's say if you don't want to learn how to pick stocks, why don't you just buy Berkshire Hathaway since the performance is so good, right? So both of the Berkshire Hathaway Class A and Class B shares are listed on NYSE, New York Stock Exchange. And the Class A shares definitely is a lot more expensive. One share is worth 212,000 USD, all right? That's one share. And of course, in US, there's no concept of bought lot size. Okay, so you can just buy one share, but one share is $212,000 because Warren Buffett doesn't believe in breaking it down into smaller denominations. But let's say you can, of course, choose the Class B, which is a lot more affordable at $141.80, right? So why don't we just invest in Berkshire Hathaway? Why go through the trouble to pick stocks? Why go through the effort to go and analyze financial statements and have to understand what he's doing? So what is the catch here? The problem I see here is that Warren Buffett to this year is 86 years old. And at the age of 86, even years before, he has already been talking about looking for a successor. We can trust Warren Buffett as a very acute, is a very good businessman and investor, right? And you trust his intuition and his acumen in business. But what about his successor? Would Berkshire Hathaway be able to continue to grow and invest at a rate of 20% per year going forward in the next 50 years when Warren Buffett is not around? So I guess most of us are not comfortable to really blindly follow and say that, okay, the next 50 years is going to be as rosy as it is for the past 50 years. So that is the reason why, for myself, I would not just invest in Berkshire Hathaway for the simple reason that Buffett will no longer be around soon. And the other way, because Berkshire Hathaway is a public company and it has to disclose certain announcements when they make investments. And of course, the recent news is about Berkshire Hathaway taking a stake in Apple, $1 billion. So thinking of this, right, why, if we know that Berkshire Hathaway has invested in Apple at $109 average price, and it would be a very fair price, right, according to Warren Buffett, Berkshire Hathaway, if they invest in it. So why, if we can invest in Apple below $109, why don't we just do so? We just piggyback on whatever he has, his company has invested in, right? So that is another shortcut. And anyone knows why you shouldn't be doing that? You know, you can just type in your answers in the text box and we can see your answers. Anyone want to make a quick guess? No one? Or anyone has bought Apple because Warren Buffett, Berkshire Hathaway has bought? Okay, someone said capital limitation, all right? But in US, you can actually buy one share, right? So you can just pay $109 and you can own Apple. Okay, another guy said because the price will shoot up upon announcement, all right? Potentially, yes, it is possible because even though they are a public company, right, there is always a delay. I can't remember exactly how many days they need to release. I think they can release like 45 days later or 60 days later after the announcement. So which means potentially there can be a lot of opportunity for other people who get the news first to front run the rest of the public. So there'll be some slippage along the way. So some of you are right that prices may move after the announcement has been made. All right. Now, let's really go into the details why Warren Buffett advantages that he has that a lot of us as retail investors, we do not. So the principal reason why Warren Buffett was able to really amass so much wealth was because he has access to large and cheap capital. So the key is large and cheap. All right. And you guys will know many years ago, he bought into this insurance company called Geico. All right, and it was a company which his teacher of Benjamin Graham was a board of directors in the company. All right, and he did bought a lot of shares in Geico. So what's so special about Geico, or why does Warren Buffett wants to buy an insurance company? One of the reasons why is because we understand that an insurance company will earn premiums, and premiums are paid by cash on a regular basis by the customers. Okay, they pay cash to the company, and as long as nobody claims, the cash is retained in the company. And what Warren Buffett can do is to use this, or he calls it the float, all right, the insurance float. He can access to this float, and then, which is a large amount of money, to grow at a much faster rate than what he would need to pay out to some of the claimants in the future. So having this large access to cheap capital gives him a lot of advantage that other people don't have. If you and I are going to borrow money from the bank or the brokerages to buy or invest, all right, easily we'll get 4-5% per annum kind of rates. So to him, he will have access to this money almost as good as free or at very low effective interest rate. So this is a very strategic part of Warren Buffett that he identified early in his career, was able to tap on the insurance float to invest and grow at a much faster rate. And a study was done recently by this Professor Frazzini. Okay, the paper was titled Buffett's Alpha. You guys can go and download. I think it's free for you to read. And he found out that 36% of Buffett's liabilities, okay, consist of insurance float with an average cost below the T-bill rate or the Treasury bill rate. Okay, what it means was that a lot of Buffett's capital that he actually borrowed from the insurance float, and it's a good 36% of the liabilities of Berkshire. And what is interesting is that the average cost is below the Treasury bill rate. Why is it so significant to emphasize that? It's because the T-bill rate is essentially the 1-year bond that's issued by the US government. And of course, nothing is safer than the government, and anything that requires borrowing will have to borrow at a higher rate than the T-bill rate. But the issue here is that Buffett is even able to make use of capital and borrow money way below what the government is borrowing at. So this is the cheapness of the capital that Buffett has access to. This is the illustration here to quantify certain things. And on top of the insurance float, if you realize in 2000, Berkshire had a way shareholders letter. Warren Buffett actually said that he does some derivatives contracts known as options. So what Berkshire did was they sold very long dated, that means very long maturity options that can last 10 years, 20 years into the future. And this kind of contract usually is out of reach of retail investors because Berkshire is able to negotiate directly with those banks to create all these products that doesn't exist in the market. And he said that he sold a put option on S&P 500, which means let's say a particular, he bets that if let's say S&P 500 index falls to level at let's say 1,100, he would actually buy up all the S&P 500 contracts and exercise options. All right, so that's essentially what it means. He's selling way out of the money options, okay, in order to collect the premium. So it works something like his insurance company, right? So he sell all these options so that he can collect the premium. And according to him, in 2008, he collected a premium worth $4.9 billion. And this money, again, he can use it to grow at a much higher rate than he would pay for the borrowing cost, essentially. So he calculated that his borrowing cost was only about 0.7% by borrowing 4.9 million with no collaterals, nothing. And his maximum loss was probably only 6.2% per annum if he was wrong with this move. So you can see again and again, Warren Buffett is able to access cheap and large amount of capital that is out of reach of retail investor. And you and I know that most retail investors, we have very little capital to work on, and it's very hard to grow to an absolute amount that we are looking at in order to retire comfortably. But Warren Buffett doesn't have this problem because he continually able to find cheap sources of capital. All right. So let's move on to point number 2. Point number 2 is that he has access to management, okay? And one of his famous quote is this: in looking for people to hire, look for 3 qualities: integrity, intelligence, and energy. And if they don't have the first, the other 2 will kill you. So he is always looking out for management that has a lot of integrity and able to be good managers of the businesses. And he's able to ascertain that is because he's able to meet management in person. Unlike retail investors, think about this. If let's say before you want to invest in a company and you call up the investor relationship office and then you say that, hey, I would like to meet your CEO, I'd like to have a coffee with him. How likely are you going to have a chance to see him in person? I would say almost next to nothing, right? But Warren Buffett is different. He's able to just call anyone and people will have coffee with him. And that's where he has the personal capacity to analyze the person, to assess the person, whether the person is a good manager, someone with integrity, etc. So this is also a pitfall for retail investors because there's always this emphasis about invest in companies that are well run by management. But this distance between retail investors and the actual managers will not realize that ability to analyze management by retail guys, right? So there is always a wedge in between. So it's not easy for us to really analyze deeply whether a management is good or not. And on top of that, right, because he has direct access, so he, of course, can do direct negotiations. And if you look at the history of how Berkshire Hathaway does their acquisition or investments, they do it through various means. So, for example, there's this term called private investment in public entities, or it can be simply put as private placements. So he can negotiate directly with the management and say, hey, I want to invest in your company. I'm going to buy this large block of shares. Would you be able to sell to me at this price? All right. So he would have be able to do all this negotiation out of public eyes and in the boardroom with all these directors and management. So this is something that, again, retail investors do not have the bargaining chip on our side to follow exactly what Warren Buffett is doing. And also, the more recent company examples will be Heinz, as well as Precision Cast Parts. Okay, a lot of these negotiations were done due even before the news and announcements were released to the public. So the advantages of the direct negotiation, as I mentioned, is that he's able to negotiate for large block of shares directly, all right? And he can buy over control of the target company if he wants to because of the access to cheap and large capital. So he has a lot of bargaining power when it comes to this aspect. And again, we do not have this position of power as retail investors. Point number 3, why we cannot succeed like Warren Buffett when it comes to investments. And because he buys a large block of shares, he essentially gains control of companies that he invests in. Not all of them, but probably most of them. And given this control, although he always professes that he doesn't like to interfere with the management whenever he invests in the companies that he has bought over, but sometimes you do see when it is time to interfere, he does. All right, and that happens to NetJets. Okay, this is a private jet company, leasing company. All right, Buffett was actually quick to replace the CEO, not once but 2 times, to make sure the investment or the management continue to run the company as in a way that he deems as properly run. All right, so think about this. Let's say we invest in certain companies. We only are minority shareholders of companies. Granted, you can go to AGMs, annual general meetings, and voice your complaint and say what you don't like to see in the company. But the management will not take your comments seriously. They will just brush you away, and they'll just continue to do their own ways as they deem fit. All right, and hence, it is unlike Warren Buffett. When he buys a large chunk of shares, he has influence over management. And even, let's say, you want to buy a large chunk of shares, you want to do a very concentrated bet on a company, you unlikely is able to influence the management in any ways. And that's why if you concentrate and yet you do have the influence, it's actually quite a very risky move to be. And that's why I always prefer to have a much more diversified investment portfolio. Because we do not have that influence and we don't have the control of management, no matter how big a stake we take in the company as retail investors. All right. Carrying on, point number 4. Okay, we talk about private equity investment. Private equity, nothing but just private companies. And again, because Warren Buffett has the money and he has the connection and he has the fame, so he again can reach out to private companies. They are very profitable and negotiate to buy over the entire company and put it under a subsidiary of Berkshire Hathaway. So for example, Berkshire negotiated directly with Procter & Gamble, which previously owned Duracell, the battery company that we all know. So in 2014, Warren Buffett actually convinced Procter & Gamble to sell the entire unit to Berkshire Hathaway. So Duracell, of course, is not listed. The only way to invest in Duracell is through the proxy by investing in Procter & Gamble. But to Warren Buffett, he sees that I can actually negotiate if I like the business unit, the subsidiary, which is a private company, a wholly owned subsidiary, I can just buy over the whole thing. And a lot of, in fact, not all the companies that Warren Buffett invested in are public companies that are within the reach of retail investors. So this is a good example where private companies are invested and there's no way that retail investors have access to, all right? Not even if, let's say, you are accredited investors and you're able to tap into private equity deals, because some very lucrative businesses like this out of reach of even most of the private equity firms out there or even funds. So if Warren Buffett were you, what would he do? I would like to take a pause down here and open the floor to certain questions because we are pretty fast on schedule. I'd just like to hear from you guys what are the questions that you may have since we have discussed the advantages of Warren Buffett that he has and not all the retail investors are able to enjoy. Questions? You can either use the text, or if let's say you want to speak out, I would be able to, I am also able to let you speak with your mic on. So we actually have Tony. Tony, would you like to speak? Tony, you raised your hand, right? So would you like to speak? Okay, I see some questions here. Julie asked, so do retail investors have any advantages over Warren Buffett? The answer is yes. Okay, and I will probably discuss about this in subsequent slides. So hold on the thought there. Sunny said he has just advised to buy ETF. Yes, he does. And in fact, he did mention also that if let's say he passed away, he would want his wealth to be invested in the S&P 500 ETF, 90% of it, all right? And the other 10%, I think he mentioned about the bonds. So yes, you say that retail investors is better off that you invest in ETF, low-cost ETFs, such as the S&P 500, or let's say you are in Singapore, the STI ETF. Malaysia, I will believe there will be this KLCI ETF as well. So each country will have their own index ETF, and being low cost, they tend to do better than most actively managed unit trusts. So if let's say you do not want to pick stocks and spend a lot of time on investment, so ETFs are definitely a very good investment to go into. It can be very simple, right? You can just buy a stocks ETF and bond ETF. That's the only two things that you have in your portfolio. So how hard can it be, right? Any other questions? We can get one more questions before we move on. So we are full house today. We have 101 out of 101 seats. So thank you all for the support. No other question. If there's no other question, I will just carry on, but do keep them coming. All right. So I stopped at this slide and I said that if Warren Buffett were you, what would you do? What would he do, right? And of course, Julie also asked, do retail investors actually have advantages over Warren Buffett? All right. So now I'm going to tell you what would he actually do if he were you. In 1999 Business Week interview, he said this, okay? He said this. The universe I can't play in, i.e. the small companies, has become more attractive than the universe I can play in, that of large companies. I have to look for elephants. It may be that the elephants are not as attractive as mosquitoes, but that is the universe I must live in. Alright, so he said this. Even though we talk about his advantages in prior slides, we said that he has access to cheap and large capital, he can deploy at will and grow at much faster rate, and money continue to grow and snowball and snowball and snowball. Okay, but he himself said that actually having a lot of money, it can be a disadvantage as well. So he said that because I have so much money, I have to look for bigger companies to buy, or he termed them as elephants. And these elephants, right, may be more pricey, more expensive than mosquitoes, but he has no choice because of the large capital he has to deploy them efficiently. He has to go for all these bigger companies, or aka the elephants, all right? And which means, in other words, comparatively, if let's say we compare a big cap versus a small cap, it is more likely the small cap is going to be cheaper in terms of valuation, all right? The price would be further or more undervalued as compared to it would be for a big cap. So given the retail investors, our advantages would be to invest in mosquitoes. All right, so that is actually our advantage as a retail investor. We can go small, while a lot of companies like Berkshire Hathaway or even the fund management, the funds, they would not be able to buy these small companies. All right, retail investors would be able to take advantage a lot more when we go small. Okay. In the same interview, he said that it's a huge structural advantage not to have a lot of money, and he did also say that if anyone tell you that the size of capital does not hurt investment return, right? He said that the person is lying, because the more money you have, by right, okay, it's a drag for your investment returns. So he said if you had less money, if you had only $1 million, he said you can do 50% returns per year. And he said, no, I know I could, I guarantee that. All right, so that's how confident he was if he has less money. And less money, he even mean like less than 1 million or even less than 10 million kind of amount. So retail investors definitely is small money in his eyes. And in fact, if we deviate away from what he's investing in and we focus a lot more on the mosquito stocks, he said that he's very confident that if you can do it properly, you will achieve 50% a year. It isn't a difficult task in his eyes. All right. Can we have some clues how he actually does it? And this is actually a video that I found from YouTube. Probably since we are a little early, so we can actually play this video. So sit back and enjoy. I'll explain to you what he actually said. All right. Let me just play it for you. I hope it's not too loud at your end. Let me know if you can hear or cannot hear it. Are you able to see the video? Not able to? Okay, let me just try again. Okay, is it playing now?
You can just, we can hear your question, please. Instead of wasting time.
All right, great.
So I read about your investment in Korean stocks for your personal portfolio. My question is, if you're managing very small amounts of money, like say 3 million or 10 million, will you still look for the Graham's approach for low PE and wider discount to book value? Will you still look for these kind of situations if you couldn't find any franchise stocks?
Yeah, if I were working with small sums, I certainly would be much more inclined to look among what you might call classic Graham stocks, very low P's and maybe below working capital, all that. Although, and I would do far better percentage-wise if I were working with small sums. There are just way more opportunities. If you're working with a small sum, you have thousands and thousands of potential opportunities. And when we work with large sums, we have relatively few possibilities in the investment world that can make a real difference in our net worth. So you have a huge advantage over me if you're working with very little money. But there are compensations to that on the other side of the equation. The Korean stocks you mentioned that I looked at 6 or 7 years ago were companies where you could only put a small amount of money in it. I was sort of reliving my youth. Somebody sent me a handbook of Korean stocks, and told me that the market was interesting. So one Sunday afternoon, I did read through a couple thousand pages of Korean stocks, and I was sort of reliving my youth. I mean, other people look through old Playboy magazines or something like that, but I looked through these old manuals of stocks, and I bought a number of stocks in small amounts from companies whose names I couldn't pronounce. But the stocks as a group were so cheap that you had to make money out of them. They were Graham-type stocks, and that's what I would be doing. I would be combing that sort of a list. Now, if I found a wonderful company that Graham wouldn't have bought, but I really was convinced about its future, I would have bought that. Also, incidentally, I've written in the last annual report about Geico, and I bought that stock in 1951 when I had about $10,000. And Geico, I bought, or I looked at, because Benjamin Graham was the chairman of the company. But Geico was exactly the sort of stock that Graham wouldn't buy. I mean, it was selling way above book value and all of that. There was a certain irony in that, but I'm glad I did it.
Right. Okay. So I hope you have heard the man himself I'm just going to break down some of the important points that he has mentioned just now. Okay, his first point, he said that if I were working with small sum, I certainly would be much more inclined to look among what you might call the classic Graham stocks. Okay, so he said if I have small amount, and small amount according to what the person asked just now was less than $10 million, he would say that if I have less than $10 million, I would invest more like Graham kind of style rather than what he is doing at this moment. Okay, so Warren Buffett would not use the same method he's investing today if he has lesser money. Okay, so that's point number one. And let's go to point number two. And he said that I would be doing far better percentage-wise if I am working with small sums. There are just way too many opportunities, right? And he said, similarly, this phrase that he has just said was very aligned or very consistent with what he has mentioned in the 1999 interview. He said that he would be getting a much better investment returns, okay, if he has less money. All right, so that's point number two. And his point number three, I bought a large number of stocks in small amounts. Okay, that's like diversification, right? The concept of diversification, buy a large number of stocks, each in small amounts, in companies whose names I couldn't pronounce. So it actually doesn't even matter because he bought Korean stocks, right? And he's not Korean, he doesn't understand Korean. But because the valuation is universal, he was able to determine that they were cheap. And it doesn't really matter whether he knows what these companies are doing or even whether the names he understands them or not. Okay, so the power of diversification is that it allows you to invest and not really have to dig a lot about companies, because if you diversify large enough, each stock is not going to make a very big difference to your whole portfolio returns. Okay, and lastly, the last sentence, but the stocks as a group were so cheap, you have to make money out of it. It was Graham's kind of stock. Okay, so because the whole group were cheap, some of the stocks, to be honest with you, will fail. They will lose money for you. All right, but because those winners would more than make up for the losers and give you a very good percentage returns out of it, because simply they were very, very cheap. And gain in those stocks would actually give you a very, very large returns. All right. Okay. So we have a question from Jacqueline, right? Would you say that the principles of Buffett's strategy of value investing and intrinsic value still holds? Okay. As I mentioned, it is very difficult. Okay. There's few ways to look at it, right? I have emphasized to you that there's a lot of advantages that Warren Buffett have that we don't have. All right. And secondly, in terms of how Warren Buffett actually evaluates stocks, right, it is still a big unknown, because even though we have a lot of literature, a lot of books trying to explain what is the method that he actually used, some would say discounted cash flow, right, to determine the intrinsic value of the company. All this, Warren Buffett has never really mentioned about it. Okay, how exactly he does it. All these books are not written by Warren Buffett anyway. They're written by authors who just want to use Warren Buffett name to sell books or to sell some programs along the way. And hence, these methods, right, that are being discussed are actually interpretations of what Warren Buffett would use or invest, what kind of methodology. But it is never what Warren Buffett has said, that is how I invest. All right. So I wouldn't say that Warren Buffett method, okay, because there isn't a real method that he has professed it, that he used. All right. So I would still think Graham method would be a lot more suitable for retail investors, because Graham has really written all these formulas, written all these valuation techniques in his books, in his own words. All right. Warren Buffett has not disclosed anything about his method. It's all interpretations of others. All right. So I would say, don't complicate the matters, stick to Graham kind of stocks. All right. So in 21.4, which is quite recent, 2 years, he was reminiscing and said that how his investment career has unfolded over the years. And he said most of his gains in the early years was actually following what Benjamin Graham has used. He did not invest in the well-known big companies that we all know Warren Buffett would invest in today, right? He was actually investing in very mediocre companies, and because they were trading at such bargain prices, it makes a lot of profit for him. And he said that Ben Graham had taught me the technique and it worked. All right. So are you keen to know that how is actually Benjamin Graham's method of investment, right? And we know that Benjamin Graham is the teacher of Warren Buffett, but why he keeps saying that, or he seems to suggest that he no longer invests like Benjamin Graham's, given his current context with large capital. So what exactly is Benjamin Graham's method? Can anyone in the audience post some replies? What is actually Benjamin Graham's method then? Anyway, I have a question from Darren. Okay, Darren said that, do you know what Warren Buffett thinks of China stocks? Sorry, I don't know what Warren Buffett thinks of China stock. Probably you have to do some search and research and see whether there are any interviews that Warren Buffett mentions. But I do remember that he bought China stock before, BYD, which makes batteries. If I'm not wrong, he pared down his position on that stock, okay, in recent years. Okay, so we have a couple of replies from others that mention about, two guys mentioned about margin of safety. Okay, so then I would like to ask further, what did Benjamin Graham mean by margin of safety then? You know, it's like a very overused word, but can we put a short definition to really explain what it is? What is margin of safety? Mingan was saying that, is it related to the Intelligent Investor written by Benjamin Graham? Definitely, yes, it is. And also security analysis, and also a lot of other interviews that he has done over the years. So a lot of Benjamin Graham's methodology has been documented very clearly. So T replied that margin of safety means low book value to market price. All right, so yes, this is one way to determine margin of safety. Okay, so a particular percentage of discount. Let's say the book value is $1, and let's say market price is 50 cents. So there is a margin of safety of 50%. Right? Jacqueline was saying discount of the market price to the intrinsic value. Okay, so yes. Then it depends how do you determine the intrinsic value. So intrinsic value can be book value, can be based on earnings, can be based on cash flow, can be based on a lot of things. All right. Okay. Raymond was saying the intrinsic value of the security is way higher than the security price. Yes. Okay. So essentially what we discussed, he moved more towards. William was saying that he moved more towards potential growth strong company versus cheap valuation stock. Yes, essentially true. All right. And also he did mention in 1999 interview why he switched. One of the principal reason or his principal consideration was because he has a lot more money, a lot more capital, because he succeeded so well buying the cheap valuation stock that he ended up with more money, and the float from the insurance business gave him even more money. So he had to move on to bigger companies, and that's why his investment strategy evolved along the way. Excuse me. And Kok Liang was asking, is Benjamin Graham's method still work today? Sorry, I had to cough. Since it is so widely used now, can we still find companies with low PE ratio? Okay, so basically, Kok Liang is asking, is Benjamin Graham method still workable today? So the answer is yes. All right, the answer is yes. In fact, I would argue against what you have said that it is widely used. Actually, it's not widely used. A lot more people are following Warren Buffett because of his success. Okay, people are always focusing on bigger companies, well-known companies. All right, and Benjamin Graham's method will tend to give you small companies, small cap, and less well-known, less familiar in businesses or in industries that people would not find it attractive or wonderful to invest in. All right, so Benjamin Graham stocks has always been a contrarian kind of stocks. Most people would find it uncomfortable to invest, and most people would find it unfamiliar to do so. So it is not widely used. And because something that is not widely used or followed, that is why it works. All right. If let's say one day all of us really know how to use, all of us actually use Benjamin Graham's method, then yes, I would say the method will start working. But given the current landscape of things, most of the invested money, right, invested capital comes from funds, and funds don't buy small companies most of the time. They buy big companies, and that's why when you look at big companies, they tend to be on the overvalued side on things. All right, Ken? Okay, so let's carry on. Yeah, see, I actually have a slide. Does it really work today, right? Okay, so front run a little bit. Okay, what we did was, some of you probably have known that we have this conservative net asset value strategy, which is actually based off the principles of Benjamin Graham. We have never deviated from his principles, just that we added certain criteria, additional criteria along the way because of certain developments in research by other notable people in the world, okay, in more modern times. So we were able to combine some of these studies together to offer a much more better criteria to pick undervalued stocks now with higher chance of taking a profit out of it. All right, and I hope that you guys can see this chart because the numbers are a bit small. Okay, so we actually have a portfolio of stocks that we invest in, okay, based on this CNAV strategy. You can see the blue line here, all right, is the performance, the returns, okay, the fund value, right, it started at $1, so now it's $1.43, right, over a period of about 3 years. Okay, and the red line is nonetheless the STI ETF returns, and we all know that it's not going anywhere since the past few years. And despite that, picking from the same market, we are still able to beat the index returns by investing in smaller companies, less well known, yet their returns are a lot more fantastic. So it was reality. We actually realized what Benjamin Graham and Warren Buffett have been saying about buying these undervalued small cap stocks, and it works wonders. And so we have witnessed it ourselves, and we have achieved it ourselves as well in the past few years. All right. And of course, we have this flagship course, the Value Investing Mastery course. Okay, so this is one-day course where we will teach you the principles of Benjamin Graham investment strategy, and of course, we'll disclose the entire CNAV strategy to you. All right. So head on there and do sign up. All right. Hope to see you in the class, and we'll share with you more about this Benjamin Graham strategy and why Warren Buffett is saying that retail investors should do this rather than follow him if you want to beat the market.